It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm Paul Peebles, National Underwriter for Old Capital, and joining me today, of course, is Michael Becker.
Hey, Paul.
Michael Becker, as you know, owns 4,300 apartment units in the Dallas-Fort Worth area. Is it 43, Mike, or is it more than that?
We just did a deal. We're about 4,600 units is the number of units we've done to date.
Unbelievable. Raised over $85 million in equity from investors. So a lot of people trust Mike, and he's done a great job. So today in Ask Mike Mondays, we want to get Mike's opinion. He just bought a large apartment building, so he must be positive. Maybe. I certainly hope he's thinking that way. But let's kind of get his state of the market itself. So the question that came in, Mike, what's the state of the market? What's going on?
We're pretty active in DFW, so I can speak most intelligently about that. But kind of nationwide, it seems like everything's going pretty good for the most part across the nation. From what I can tell, certainly the very top of the market is getting a little frothy, especially in certain pockets of like urban core, central business districts, with the amount of new supply coming on market. So it seems like, with the exception of the urban core, top end of the market, the A++ type product, which they're delivering a lot of that supply, the rest of the market's pretty good. What we focus on here at Old Capital is, obviously predominantly Class C and Class B multifamily. So that's really what we see in a lot of loans we do are in Texas. Quite a bit of loans in Austin, San Antonio, and then DFW, which is where we're based. But, kind of what I see, it seems like more and more that the spread between the A's and the C's kind of flattening on the cap rate. So coming out of the recession six or so years ago now, really the first part of the asset class that recovered, and the multifamily asset class that recovered, was kind of the top of the market. So the A's are the first ones to kind of come out of it and recover, and then the B's followed, and then now the C's have kind of come and followed. And what I've kind of been observing in the marketplace, it seems like the spread between and the cap rate between the A and the C is really much smaller, much more narrower than it was a couple 3 years ago, where it was 300 to 400 basis points higher of a cap rate to have a C property than an A property. Anymore, it seems like it's 150 to 200 basis points from my observations and deals that we're doing. So what we're personally doing within my group, SPI Advisory, is we're focusing kind of on the top end of the workforce housing scale, kind of the B to A minus product. So kind of think mid 80s to mid aughts is kind of what we're looking at for asset quality, something a little bit better value add. Because it seems to me that you're just better off getting a little better asset quality, a little bit of location, and your risk adjusted returns are going to be better on the top end of the market for that kind of workforce housing than it is on the lower end of the market. That's really what I've been kind of seeing. It's certainly super competitive out there. Rental rates continue to go up, with the exception of the urban core, very top end A+ of the market. So fundamentals seem pretty strong. Occupancy is still pretty strong. Traffic and demand is still pretty strong. So we're still pretty bullish in the C to A minus kind of space, but really kind of focusing on the top of the B, kind of low end of the A. Really seems to be doing pretty well, and that's kind of what we're focused on, Paul.
Any other areas that you guys have looked at that you kind of have your ears up to try to find other properties?
Like market-wise?
Market-wise.
Yeah, so we've been continuing to look at Houston, and we think that might be a moment in time, but I just haven't seen the pricing come down to justify, in my estimation, to make a move into Houston yet. We just spent some time in Minneapolis. I'm intrigued with that, so I'm looking into Minneapolis a little bit. I know you guys did a big loan in Indianapolis recently, right, Paul? Maybe you have any thoughts?
Yeah, we like Indianapolis. We like Minneapolis. There's a big group of large, mid-sized cities that we do like, whether it is Nashville, as an example, Atlanta, Raleigh, Durham, some of those areas too. One of the things I did want to talk about is really, really quick, where I think that the market is getting a little ahead of itself, and I hate to tell you that, but I think it is a little bit, is interest only. And one of the things that we've been seeing quite a bit of, which I don't like, is 5 years of interest only on some of these loans. They may tweak rates of return for investors to invest in these deals, but the 5 years interest only, the downside is that it artificially tweaks the valuations too on properties. It pushes property values even higher. So coming out of the recession, like Mike was just talking about, we probably didn't get any interest only. Then it became 1 year of interest only. Now it's become 3 years of interest only. Now we're starting to see 5 years of interest only. And I'm talking about 5 years interest only at high leverage, at 80% leverage. So if you can get it, I guess get it, but we're not big believers or fans of it. We think that it inflates valuations too much. So that's just my soapbox speech for today.
I guess the one thing that kind of concerns me is really, I know I pounded the table on this a bunch, but I'm seeing people buy properties in very questionable locations because everyone's searching for yield and cap rate, and then go into the higher crime locations. So the example I've used before on the podcast is I'm seeing people treat South Dallas like it's South Irving. So if anyone local knows that, and those are two different markets, they might look very similar from an outsider's view, but South Irving is a good, clean workforce housing community with lots of employment and low crime, and South Dallas historically has had higher crime and higher vacancy levels and lower socioeconomic area, lower average area, median income around there. And what I'm fearful is that people, everything is full now because the market's tight, especially in the workforce housing place. So these people that are getting priced out of South Irving are going down to South Dallas. And so the rental rates are up and the occupancy levels are up. But I'm a little worried that whenever we do hit a soft patch in the economy, that the economic vacancy might underwrite 10% for both, but when you hit a bad spot, South Irving might go to 15, South Dallas might go to 30 economic vacancy. So that's what I'm seeing as a concern. I don't know if you noticed much of that, Paul.
What the hell do we know? We're just dumb bankers by training. But I've been through for 34 years. I've been through a couple different cycles, and so I just kind of see some tells in underwriting and some problems possibly out on the horizon. So some great information today, Mike. So anything coming up for us?
Yeah, on June 7th, we're having Amy Morgan from CBRE Appraisal. She's one of the top appraisers there. CBRE Appraisal is one of, if not the largest appraisal groups in the nation, certainly in Texas. They do a whole bunch of appraisals on multifamily. Her name is going to speak at the Old Capitol Speaker Series at the Grapevine Convention Center on June 7th. That starts about 6:30, I believe, is when we kind of start that. Have a little bit of networking out of the gate, and she'll probably go up and speak around 7 for about an hour. It's a good event. Last event we had was Dr. Mark Dotzauer. We had almost 400 people there. So we should have, a couple hundred people, I would imagine, at least at this event. It's a good event that a lot of people look forward to and go. So I certainly learn about kind of how do you add additional value in this hot market that we're in from the appraiser's perspective, as well as a good opportunity network and meet a bunch of other investors who are in the marketplace.
It's an event to attend. Also, don't forget, if you do have an interest in kind of understanding how these property financing gets structured for apartments, take a look on our website, Old Capitol Podcast. Download the Old Capitol Podcast white paper report, 15 pages of how to structure apartment lending. Second thing also, too, is that Michael's due diligence report and what to look for when you do buy a property, to kind of have a checklist of what to ask for from the seller, just to make sure that you're on top of things, just to remind you what you should get, what you want to get. And so make sure you download that report. Anything more, Mike?
That's it. If anyone likes this podcast, we certainly appreciate ratings and reviews on iTunes or Stitcher, one of the other podcast aggregators. If you have any future questions for Ask Mike Monday, certainly also go to oldcapitalpodcast.com. There's a form there where you can fill out and ask a question we can answer in the coming weeks.
Sounds great. That was Michael Becker. I'm Paul Peebles. Thanks for listening. We'll talk to you soon.